30 days ago, I did something a little crazy. I took $10,000 and invested it across the top 100 cryptocurrencies by market cap. That's $100 into each one, from the big giants like Bitcoin and Ethereum, all the way down to some projects you've probably never even heard of. The results? Well, they completely shocked me, and I think they're going to surprise you too. Welcome to the great crypto experiment. So, why did I do this? It's simple. Every day we hear about the next big coin that's going to the moon, or we see headlines about the entire market crashing. It's confusing, right? I wanted to cut through the noise. By investing a small, equal amount into a huge range of projects, I hope to get a real, unfiltered snapshot of the crypto market. Is it really all just about Bitcoin? Or are there hidden gems in the top 100 that are outperforming everything else? Is diversification really the key? Or did I just throw my money into 100 different digital holes? Let's set the stage. I used a major exchange to make the purchases. The date was exactly 1 month ago. I documented every single transaction, the price I bought at, and the fees I paid. The total investment was precisely $10,000, plus a little extra for those pesky transaction fees. My plan was simple: set it and forget it for 30 days. No panic selling, no taking profits early. Just a pure hands-off experiment to see where the chips would fall. Alright, let's get into the setup process. It wasn't as simple as just clicking one button. Buying 100 different cryptos is a marathon, not a sprint. First, I had to make sure the exchange I was using actually listed all of the top 100 coins. Spoiler alert, most don't. I had to use a combination of a couple of different platforms to get access to everything. This meant creating new accounts, going through verification processes, and managing multiple wallets. It was a logistical headache, but for the sake of science, I pushed through. Then came the actual buy-in. I set a specific time of day to execute all the trades to try and get a consistent market price. For each coin, I placed a market order for exactly $100 worth. The fees were an interesting part of this. Some were a flat rate, others were a percentage. In total, the fees ate up about 1.5% of my initial investment, so around $150 right off the bat. That's an important factor to remember. Your investment is never just the sticker price. Once all 100 positions were open, I consolidated everything into a portfolio tracking app. This was crucial. It gave me a real-time dashboard to see the entire experiment at a glance. Seeing all those little green and red percentages next to 100 different names was both exciting and terrifying. With everything set up, the waiting game began. For 30 days, I resisted the urge to check it every 5 minutes. I promised myself I'd only do a final reveal at the end of the month. Before we dive into the results, let's talk about the market conditions during this 30-day period. It wasn't a crazy bull run, nor was it a catastrophic crash. It was what you might call a typical, volatile month in crypto. There were some green weeks where everything seemed to be going up, and some brutal red days where my portfolio took a nosedive. We saw some news about regulations, a few project-specific updates, and the usual dose of social media hype and fear. This is important because it means the results aren't skewed by some once-in-a-lifetime market event. This is a realistic look at what can happen during a relatively normal month. Okay, the moment you've all been waiting for. The big reveal. After 30 days, I logged into my portfolio tracker, took a deep breath, and looked at the final number. My initial $10,000 investment had turned into, let's break it down. Of the 100 cryptocurrencies I invested in, 62 of them were in profit, and 38 were at a loss. So, a majority of the top 100 coins actually went up in value during this period. That was my first surprise. I expected it to be closer to a 50-50th split. The distribution of those gains and losses was what really blew my mind. Let's start with the losers. The biggest loser in the portfolio was a DeFi project that I won't name directly, but it dropped by a staggering 42%. My $100 investment in that one was now worth just $58. Out. Several others were down between 20% and 30%. These were mostly smaller cap coins in specific niches, like gaming or data storage, that had a rough month. Seeing that bright red 42% loss really drives home the risk involved with individual altcoins. If I had put all my money in that one coin, I'd be in a world of hurt right now. But now for the fun part, the winners. My biggest winner was an AI-related crypto project. It absolutely exploded. My initial $100 investment in this coin skyrocketed to $275. That's a 175% gain in just 30 days. It was a classic case of the right narrative at the right time. The hype around AI was massive this month, and this coin rode that wave perfectly. This single winner alone made up for the losses of my 7 worst-performing coins combined. And it wasn't the only big winner. I had 3 other coins that gave me over a 100% return, doubling my money. One was a Layer 1 competitor to Ethereum, another was in the meme coin category, and the third was a new blockchain interoperability project. These four massive winners were the engine that drove the entire portfolio's profit. It's a perfect illustration of the power law in venture-style investing. A small number of huge successes can carry the entire portfolio. What about the big boys, Bitcoin and Ethereum? They are the largest part of the top 100 by market cap. So how did they do? My $100 in Bitcoin grew to about $107, a 7% gain. My $100 in Ethereum went to about $110, a 10% gain. They were solid, stable performers, chugging along nicely. But they were nowhere near the top performers in my experiment. They essentially performed right around the average of the whole portfolio. This was the biggest shocker for me. While the giants provide stability, the real explosive growth, at least in this 30-day window, came from the mid-cap altcoins ranked somewhere between 20 and 80. So, what are the key lessons I learned from this experiment? First, diversification is powerful, but not in the way you might think. It didn't just smooth out the bumps. It gave me exposure to those massive, unexpected winners. I would have never picked those for 100% plus gainers on my own. It was a numbers game. By buying 100 lottery tickets, a few of them were bound to hit. If I had only invested in the top 10, my return would have been much closer to that 7 to 10% range. Good, but not life-changing. Second, the crypto market is heavily narrated. The AI coin's success wasn't random. It was tied directly to a global trend. This shows how important it is to not just look at the technology, but also at the stories and trends that are capturing people's attention. The meme coin that doubled is another perfect example of this. It has very little utility, but it captured a moment in internet culture, and the price reflected that. Third, fees matter, but they aren't a deal breaker if your strategy works. That $150 I spent on fees felt painful at first. But with a final profit of over $870, it was just the cost of doing business. However, if my portfolio had been flat or down, that fee would have made the loss even worse. It's a reminder to always factor in your costs. Finally, this experiment showed me that there's life beyond Bitcoin. While Bitcoin is the king and the most important asset in the space, focusing only on it means you might be missing out on incredible growth opportunities elsewhere. The risk is significantly higher with these smaller coins, of course, but as my portfolio shows, the potential reward can be astronomical. So, would I recommend this strategy to others? That's the million-dollar question, or in this case, the $10,000 question. I have to be very clear, this is not financial advice. This was an experiment, and the results from one 30-day period are not guaranteed to happen again. The market could have easily crashed, and I could have lost a significant amount of money. However, the principles behind the experiment are valuable. The idea of broad diversification and making many small bets instead of a few big ones is a proven strategy in other areas, like angel investing. It seems to apply to crypto as well. It's a way to manage risk while still giving yourself a chance at those wild, outsized returns that make this asset class so exciting. If you were to try something similar, you could do it with a much smaller amount of money, like putting $10 into each of the top 50 coins. The principle remains the same. What an incredible journey this has been. From the tedious process of buying 100 different assets to the thrill of seeing the final results. This experiment has taught me so much. It's easy to get lost in the day-to-day price charts, but taking a step back and looking at the market from this bird's-eye view was incredibly insightful. The crypto space is volatile, unpredictable, and risky, but it's also filled with innovation and incredible opportunities. My $10,000 portfolio is proof of that. A couple of big winners can make all the difference. What do you think? Were the results what you expected? Would you ever try an experiment like this? Let me know your thoughts down in the comments. I read every single one. And if you enjoyed this deep dive and want to see more crypto experiments, make sure to hit that like button and subscribe to the channel so you won't miss what's coming next. Thanks for watching, and I'll see you in the next video.